How do you truly know if your venue is performing well? Today, I'm here with Lan from Success Accounting Group, a successful business coach and owns her own accounting firm. And we're here to talk about understanding the benchmarks of restaurant profitability and what are the key points you should be looking at. So welcome, Lan. Thanks for coming in.
Thanks, Jamie. Thank you for having me here today. And it is my pleasure to explain to you, how do you know your business is actually doing really well, or is it just break even, or is actually underperforming? Well, the easiest way to know is we compare our clients against the ATO benchmark. There is a benchmark for every industry, in fact, but today I'm going to focus on restaurants.
So what are the key benchmarks for business profitability?
There actually are 6 key benchmarks that ATO measure against, but I'm going to cover 3 today. The first key benchmark is annual turnover over cost of sales. Now, depending on your turnover, so they have different ratios for business owners over 2 million, business owners from 500 to 2, and then under 65,000 to 500,000. Now, if you're interested in learning about these benchmarks, comment below and we can send you a copy of that. But the first benchmark is turnover over the average cost of sales. So we're looking at around 34 to 35% for that. And if you're under that, that means that you are actually doing really well. But if you're over that, that means your cost of sales is way too expensive, or you're not running the business very efficiently. Okay, so that's the first one. The second benchmark is the labor versus turnover. Labor means your contractors, your casual workers, super, and anything relating in the cost of hiring your employees and your team. So we had a look at the average around Australia, and the average in the range would be between 23% to 34%. So if your cost of hiring staff and subcontractors and casuals is more than 34% of your total turnover, that means that the wages is too expensive for running a business, and therefore that would impact your profitability, and your profit would be reduced.
So currently in the industry, I think we all know that it's quite hard to keep your margins at that level, especially when it comes to staffing with the rising costs of wages and salaries and the shortage of staff in the industry. As a business coach and owner of an accounting firm, what measures or case studies do you have that would highlight how to combat that?
That's an excellent question, and actually a question that many of my clients come and ask me during their coaching, and not only just restaurants, but also service-based business, as well as even any retail business as well. The first thing I would say is you need to review your business to make sure that your operation is in fact technology driven as possible. Yes, the restaurant business, you have to train in staff as well, invest in your team, invest in them so that you're not working in the business, but you're working on the business all the time. The other thing I've noticed is that to increase profit, a lot of people try to cut a few hours here, a few hours there, to cut the wages short term, but what that does is it leaves them reduce the morale of their team. When they lose the morale team, staff turnover increased. So that means staff will leave. That means you spend more time training new staff, therefore blow up your cost of wages. So that is a no-no. You don't do that. In fact, I would suggest that you put training in your team so that they stay with you, so that you have more time, free time to work on the business to become more efficient with technology. There are so many ways that you can improve your business as long as you have a great team, a loyal team that knows that you appreciate them.
Yeah, there's some great words. I feel like it's what the industry needs to hear right now. A few people are talking about it, but I think not enough. Apart from that, with wages, what would be some other, benchmarks that you'd want to be looking at?
Yes, as I said, I'm going to share with you a third one, and that is the turnover over rent. Rent, paying for your cafeteria or restaurant. Now, people say, how can I improve that? Well, first of all, know what the range is, and then once you know the range, you can reduce or improve that. The range, in fact, is rent over turnover is between 8% to 18%. So it depends on the size, the turnover of your business. So for example, a business over $2 million, we're looking between 6 to 9%, and a business under 500,000, we're looking between 12 to 18%, so a bit higher. Now, One of the things that I tip that I can share with your clients and your community is that if you're paying a lot of rent and you're not using all the facilities, then potentially you can sublet a portion of that space to, say if you're a restaurateur, you don't have a bar or a coffee barista, you can sublet that to a barista so that you not only can reduce your rent cost because the barista is paying your rent, but you can drive in more traffic to your restaurant as well. So that's just a tip for you to reduce the percentage of your rent as well as driving more traffic for your business and your profitability.
Yeah, fantastic. That's a great idea. So Lan shared some great insights today into benchmarking for the hospitality industry specifically. And look, if you are serious about improving profitability for your venue and really making sure that you can push through these hard times right now and continue growing your business, I'd recommend booking in a call with Lan and her team. So for all your action takers, if you want more information on this, comment below benchmark and we'll send you through some extra information and a link to book in a assessment call with one of us.